Hi everyone, welcome to another episode of World of Oil Derivatives. I'm Greg Newman, the CEO of Onyx Capital Group. And after our data kind of focused podcast last week, we're getting back into market talk and little bits around that. I've got Vincent Wu here from the research team to discuss it with me. Vincent, if you don't know, please check him out either on the Onyx Capital Group page or on his own page on LinkedIn. He does some very amusing summaries and reactions to the market that he calls Wu Fridays. So that's a weekly thing. And it's very popular, at least internally. And you're getting a lot of views. A lot of people like it. I showed you, right? All the top majors, top trade houses, they're coming up as views. So
yes,
you're getting out there, man.
Yes. Hey, Greg, good to be here. And yes, we've been seeing a lot of positive reception to these videos. The stats don't lie and the metrics show that yes, the audience is very wide and it's not just within the oil industry. But
you know what it is? You're the first person I've ever met who can make a subject like oil swaps funny. Mm-hmm. So I think you need to hold on to that and keep going.
Yes.
It's enjoyable. And yeah, utilizing kind of the media stuff we have as well. So cool, man. We'll speak a bit more about that later, I reckon. But yeah, we need to talk about, from a market perspective, it was a bit dull in the last couple of weeks, but we've got the OPEC meeting this Sunday. So it's interesting, isn't it? Because we're all about the flows and the trader positioning, the behavior. So trying to capture the sentiment of the market right now. How should we summarize kind of what's going on right now and the kind of thoughts for the market collective for Sunday?
Yes. So all of this financial flow stuff, it seems to be getting into the news a lot more. Agencies, outlets, journalists, they're all talking about the positioning stuff, what OPEC is doing, how they're targeting short positions, short investors. And recently the Saudi energy minister came up, talked about how he wanted the short speculators in oil futures and Brent futures to watch out, or there would be a lot of pain coming up as
like
they
to say ouching.
Ouching, yes.
Do you ever ouch?
So sometimes.
I think ouching in this definition is always about being short. So and getting caught short, and it definitely worked. When he was saying it, I think it was 2020. Was it 2021 when we first said it, or 2022? People getting short, right? I'm going to make sure they're ouching like hell on the trading floors. No, it's 2021. And okay, fine. So it works. The market wanted to be bullish at that time anyway. Yeah, it was very hard. It was a very clear signal that they were going to cut. But we've cut 3 times since. I think I'm correct in saying, when middle of wars, sanctions, lack of production, lack of storage, throughout all this period, there's been cut after cut after cut. And yet we are where we are, which is physical differentials negative, storage very healthy levels. So it's just not, I guess what I'm saying is it just doesn't seem that believable. And I think we could talk about the hedge funds positioning that should reflect that, right? Hedge funds being kind of the fast money sentiment guide of markets, right? All traders tend to have longer term positions. And yes, they have very big positions, but because they don't really materially shift them that much throughout the year, their direct impact on the market is kind of, how would you describe it? Like instant at the time as they build a position, but then obviously no real impact as they hold their position. Whereas hedge funds are in and out rapidly and they react to things like this. Yeah. So what's going on with the hedge funds? I want to put it that way. Their sentiment.
Going on with the hedge fund, so yeah, they've just been building up a lot more short positions over the past few weeks,
and they've mentioned that Saudi have mentioned that.
So it was explicitly designed to target these short investors. And as you mentioned before, these hedge funds, the fast money, they come in and out very fast. They trade on a short-term basis, so in that sense, they have a magnified impact on price action. So of course, very responsive to new market headlines. And of course, if you guys pull up the first picture, we can see there has been a build up in a lot of short positions, and the outright number of shorts. So investors are betting that prices are going to go down. That the highest level that they've been since the pandemic era in 2020. So
the pricing war.
yes, so short positions are at a 3-year high.
Yeah, I mean, but I'm saying then was like the most all-time best time to short you've ever seen. It was so clear that, you know, with this excess production coming online, forced into the market, it was obviously going to lead to a sell-off.
Yeah.
So to be like flirting with those levels, yeah, it's pretty damn bearish. At least the sentiment. I'm actually even curious. I can see the physical differentials. Like I said, they're weaker in the front in dated Brent, but come on, it's not like there's every bearish signal in the market. So it's actually quite interesting that there's so much confidence being short. What do you reckon? Maybe the reaction from last time in April. You see what I mean?
Yeah.
So in April, it was the hedge funds that were short. They bought back. The shorts that were short bought back on this headline. And then hedge funds bought up only for oil traders to sell to them, liquidate their long position, and for the market to go all the way back down again. So they're in this game of poker going, I'm not going to believe you for the 15th time. You know, like you keep saying, I'm going to cut, oh, I'm going to ouch the market, whatever. But it keeps going lower, right? This time, there's nothing you can say that's going to deter me from holding a short position. It's got to be what it is.
Yeah. So yeah, twice over the past year that OPEC has attempted but failed to defend a price floor. So in November, it was a cut at around $90 per barrel. And of course, in April, the surprise cut announced on a Sunday saw prices rally by around $6 at the start. So from 78 to 84, 85, it sat there. But of course, the rest is history. Prices came down to the low 70s. So they have failed to try to defend the price floor. And it is interesting. I saw somewhere that the break-even price for Saudi oil productions, it's at around $78 per barrel. So in that sense,
this is for their like budget, you mean?
Yes. So,
not their break even, right? Break even is probably like $5 or something silly low.
Yeah.
You mean for their budget?
More for their budget.
Yeah.
So it would be in their Saudi's interest to continue cutting prices.
Cutting production.
Cutting production.
But does production have its impact? Is that like, you know, it's moved into, as last year showed, about trying to capture the imagination of the collective market. And my God, did they get captured in 2021 and then into 2022 early, like the whole world was long. And we saw the ramifications of that. But I think we also saw the ramifications of cuts not having their immediate impact into the price, or a sustained impact into the price, I should say. So, I mean, when you're threatening a cut and you've already cut a few times from your kind of high production, I mean, it infers that you've completely lost control, is what I'm trying to say. And the hedge funds are essentially saying that, right? I mean, no matter what you think, we're short, we're going to put our money where our mouth is. So how do you influence the investor mindset now that that's the wrong position to have and you should be buying? You either need to do something ridiculously drastic, or realistically, I think you're going to have to wait for a reset. But what do you think? I mean, this is the whole point. Interpretation of behavior is as subjective as it gets, right? So what do you think?
Yeah, it's all psychological. Game of chess, perhaps even a game of chicken between short investors versus OPEC. It's very hard to say. For all we know, there might not be a cut announced this Sunday. There might just be. They might just say that, oh, production will be unchanged.
And that's key, right? If they say production is unchanged, they're renewed confidence in being short. Right?
So essentially, even though there's no material changes, it's traders the fast money might interpret that as being short, as a bearish headline.
I think so. I mean, it's a kind of basic principle, but like a couple of weeks ago, I was interested because whilst the market had been on a kind of bearish trajectory, hearing rumors of oil traders starting to pick up on the lows or the recent low, buying the dip. And then we had a really bearish headline out in the form of US stocks, massive builds. And yet the market just didn't move and actually went up by the end of the week, or by the end of the day even, I think, which kind of spoke to when there's a clear bearish headline and the market absorbs it and goes bid, there must be a lot of buying flow in the market. So that would be where I say the market was re-entering on the dip.
Mm-hmm.
Lots of flow that came in, and since it's kind of stagnated again. But on the flip side of that argument with the headlines, if everyone's expecting this to be a bullish headline and then there are no production cuts, it's de facto bullish. It's all about weighting up. Not necessarily, I think the market's going to go down or I think the market's going to go up. It's more like, do you want to be in your risk? Because I think it's almost a bit of, there's so many emotions at play when traders are trading, right? Like the hedge funds, for example, if you're fast money, you've got to make your bonus by the end of the year, or you want to make money so you can get a bonus at the end of the year. You'd probably be quite frustrated. Hang on a second. The fundamentals say this. All the research agencies saying that the market's bullish. It's going to be bullish. Everyone's saying oil's going to go back up to 100. And then OPEC cut. Right. Awesome. Like, buy. I'm done. I'm going to make my year. And then your buying gets absorbed and then it sells off. You're going to be pretty annoyed, right? You're like, I'm not just going to stop listening to all these idiots telling me, you're going to feel like that, right? And if anything, you're going to react by getting short. You still got to trade. You still got to make money. So you get short, and you get my point. Is in like there's those kind of reactions at play. So, but this time it's the other way around. There's all this almost like overconfidence in being short, which I actually don't know where it's coming from, because it's not like the market's like in pieces, right? It's not like there's like all these signals of massive oversupply, slight oversupply, yeah. So I'm not really sure where that's coming from, other than the macro sentiment. So I think it's more about the oil traders. Are they positioning in for the long run? Probably, right? Because they're bullish second half. We know that. The market consensus is bullish second half of the year demand-wise. So buy now and hold it basically for when that materializes, probably in the summer contracts, like when it becomes August and all that. Okay, so they're probably going to hold on to that length. So what drives the market lower when the market's already short and these guys aren't willing to sell their length? That's the counter argument to what I just said. So that's why I think it's quite interesting. What do you reckon?
Yeah, it's that's another way to interpret it. Of course, it's not just the fast money that you have the bullish ones, you have the short guys that all loading up on these positions. You also have the oil traders, which are not categorized as fast money or managed money. They're more under the producer merchant category, and yes, and they don't have an immediate rapid impact on price action, but they
can if they're switching positions.
If they're switching positions,
but if they're not, it tends to be a bit more steady. Yeah,
perhaps a bit more steady, as you mentioned. They might be loading up positions for the second half of 2023. So yeah, so I think with the managed money stuff, there is definitely there's an outside impact from the macro sentiment, because earlier in May you had the US regional banking crisis, weak economic data out of both the US and China as well, and talks about more interest rate rises. So that was a big thing, with a lot of bearish headlines coming out at the time, which probably drew in a lot of short investors. But it's also worth mentioning that there was at least for Brent, it seems to have a price floor of at least $70 per barrel. At the time, there were talks, what if it falls below 70? A lot of market analysts were fancying the real possibility of prices going even lower. But it seems like for the past month, at least prices have held steady around the 70s region. Maybe not.
But that's coming from the oil traders, I would argue.
From the oil traders, but also you could say managed money to an extent as well, because perhaps if it falls below 70, it would trigger a lot of stop outs.
Yeah, a lot of taking profit.
Yeah, or
so where does the new flow come from? That's always the question we ask, right? So we know the state of the market, the positioning.
Yeah,
really, really short from hedge funds, but not, I wouldn't argue short on the oil traders, big volume side of things, trade houses and majors. So where do we go now? The weird thing, right, I was just thinking, is that if you're macro bearish right now, as in, collectively the financial markets.
Yeah.
If oil does go up, ironically, it makes you bearish again because of the inflation argument. And the main reason why people are bearish the economy is the inflation figures. So the more commodities go up, the more it makes the bearish argument make sense, which then filters into bearish oil. Do you see what I mean? Yes. It's not like it is it's just like what I'm getting at is, what OPEC need to do is convince, if they want the prices higher, they need to convince investors to be long. And that circular argument, it's like, yeah, but if I get long and the market goes up, then inflation gets bad, the economy gets bad, and then oil should go down again because of lack of demand. You see what I mean? It's not really a convincing argument. They're just like, force a high price because I'm going to cut to death. You see what I mean?
Well, eventually prices the market tries to find a balance, right? Prices will find like an equilibrium, because last year prices were so high, it was contributed to energy inflation, high oil and gas prices, and it led to a lot of demand destruction as well. We could see that with distillates and gasoline as well, in addition to natural gas. So of course it can't go too high, but I suppose OPEC wants the bullish OPEC and bullish investors, they want to find a reasonable level that's higher than current levels, but of course not so high to the point that it would.
But that's a tight range, I think.
What range do you think that?
I think above 80. If you start getting up to 80, 85 again, I think the conversation, especially if, well, you need the product cracks to perform as well, right? So we had really high gas oil cracks at the beginning of the year. So when oil did go back up to 85, you had still quite high gas oil cracks. So I think they're a lot lower now. So maybe the floor, maybe the level I'm talking about is maybe more like 85, 90. But regardless, I don't even care about I'm just purely coming at from the angle of, if you want me to put risk on as a hedge fund, macro portfolio manager, it doesn't, I don't get the argument. Like, it's not convincing enough for me to put $1 billion management from, a pension fund into getting long oil prices. I just don't see it collect. I don't see what they would be thinking other than, OPEC might cut. So, yeah, but they've cut 1 million times and it hasn't had the impact. And now we're getting all these talks, these headlines being like, Russia won't want to cut. And the Abu Dhabi guy, the ADNOC guys didn't want to cut, or at least gave signals last year that they don't want to cut anymore. So it's a market share argument now. Iran might come back online is the latest one. I mean, even though I don't think that makes much of a difference, and we can talk about that. But regardless, it's just about looking at it on the balance of probabilities, right? So I remember in 2014, all the way back then, it was, what is the state of the market? In other words, like coming into the OPEC meeting in 2014, the market had been like a massive sell-off. And it was like, should the market, are we like in an oversupplied world or an undersupplied world? In the physical oil market, we're in an oversupplied world. Balance of probabilities, like what is it like? They haven't made a cut announcement for a long time, and basically the market, everything from the market positioning to the physical, it was skewed to the downside. There was still a lot more for it to go, and so therefore, it's one of those things where there needs to be a really convincing argument for it to stop the momentum, rather than there needs to be an argument for it to be a certain price because of something in the physical market. You see what I mean? That's how markets work, right? It's all about positioning, momentum, whatever. So what is the really strong argument that encourages the new flow, being some macro portfolio manager being like, do you know what? I don't want to be short anymore. Or do you know what? I want to get long. When you did that in April, it didn't work. When you got all the exact same signals, and you did that in 2022, it didn't work, despite the most bullish physical market probably ever. Yeah. So why would you risk it now? That's my point. Behaviorally.
Yeah. So it's now it's in a, perhaps as you mentioned, like this, maybe it's the producers are in a damned if you do, damned if you don't situation. So if they cut, it might not working, and prices might not even go up. Prices might fall even further.
Right. Yeah. And now you've lost market share.
You've lost market share. But then if you don't announce anything, production remains unchanged. Market share, you retain the market share, but prices could become. But you've signaled to the market. Might be a bearish headline.
Yeah,
anyways.
I just think you've signaled to the market that you've reached it's like the rate cuts. You've reached the end, so you can't do anything else. So if the market falls below 70, what are you going to do about it? You've already used all your chips.
Yeah, that's an interesting one, because of course in the oil production, there's always going to be room for more cuts, but the question is, does it seep into the market share? So you want to find balance in both.
Yeah,
I suppose.
And you got to do it collectively. That's the whole point. That's the power. You can't just have one country doing it.
Yeah. So it does seem like perhaps the OPEC, of course, they're very, very relevant, but in terms of the actual impact on global oil prices, perhaps it's they have less of an influence.
Well,
these
right
years
now, because of
compared
whatever the state is we're in, which I guess is a macroeconomic weak market,
to-
and then on the backdrop of that, and there not being particularly bullish signals in the prompt right now, the hope is second half.
Yeah.
And if that doesn't materialize, then yeah, like forget it. But anyway, either way, just to come back to that point, where does the new flow come from? I don't know, but you could argue that the most important trader right now is the producer, because the end user should be steadily hedging as the demand filters through, right? If the airlines and trucking, these kind of things, if there's demand, they need to just continuously hedge, right? And that filters in. And we have seen a lot of jet fuel hedging, actually. We saw it last month quite considerably. So what is the producer doing? The producer that hedges, what are they doing? And I think that if you haven't hedged right now and you saw what happened in April, I mean, your job is to protect prices. I think with the risk reward skew to the downside, like my argument there, I think the producer flow might come in and be the kind of domino effect, but could very easily be wrong because of how extended the hedge funds seem to have got, which, I mean, that was really surprising for us. Like I thought it'd be more steady than that, and really, really aggressively getting short. So yeah, if there's a new buying flow somehow, then that's the more vulnerable one because they're fast money and they tend to stop out quicker, blah, 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 blah. But anyway, I guess we don't know. We don't have huge conviction either way, but I would say skew to the downside.
Skew to the downside, but won't be surprised if prices rally as well. Because
it could go up, it could go down, it could go sideways.
At least temporarily, and in the next week it could go up.
I was just joking around with you. Sometimes you're in a jovial mood, sometimes you're not. Sometimes you're very serious, Vincent.
Yes, well, can't be jovial all the time, right?
No, it's not.
Nor serious. Find a balance. It's just like market share versus production.
Vincent, happiness production levels. So we need to talk a little bit more about this though, because it was the other key headlines around this were, okay, the short position, we said all that, the Iranian production. If we whack that one up, that headline. So not really sure why this suddenly is getting news. I guess it's just because the Secretary General of the OPEC said that they would welcome Iran's full return to market. Yeah. Cool.
Yes. So the Secretary General visiting Tehran said that Iran has the capacity to bring on significant production volumes within a short period of time. So that means it's oil export volumes that would be competing in the global markets. So in the short term, it's expected to have a bearish headline, and
seems like a bit of a warning if you ask me. I'm sure there will be good work together in synchronization to ensure that the market will remain balanced as OPEC has continued to do over the past many years, i.e. when you weren't involved, I guess. So my argument would be that Iran's always been online. They have had sanctions for so long. I just think it's just priced into their economy effectively. They've figured a way out to make this work. However, if they suddenly do come back online, I think we've seen before, there's a lot of floating storage tankers with oil, Iranian oil in Singapore and other areas where they would suddenly be able to move and, flood the market to some extent, but that would always be temporary. I think the interesting change would be the freight, because freight, really obviously comes off when there's less use of tankers. And I think when the sanctions happened, it was quite bearish freight, and that coming back online will be bullish freight, more competition for tankers. And Iran will probably try to clear as much as their oil into Europe as they can, because they were used to the Eastern market to clear it up until now. That boosts freight prices, and freight prices have been kind of the key thing in keeping exports to Europe really high from, West Africa, and the US, more importantly, as their productions increase, as their exports have increased. The freight prices have been very attractive in the sense of making that export to Europe work. So if Iran suddenly come into the picture, that closes that and maybe reshapes things a little bit, but it comes into the market share argument, because if Iran start competing with Europe again, you got Russia competing for China and India, and no longer Europe. Iran now come in and compete with Europe. So again, it's just going to become about global production because everyone's online to just reshape the flows. Whereas Russia can't go to Europe, so they have to focus on East. So it puts OPEC in particular in a really tight spot, market share wise. You see what I mean?
Yeah, because it seems that with the price cap, Russia, of course, they're sending, and the EU embargo on various oil products or Russian diesel, all of that. Global trade flows have been rerouted, so Russia is turning towards the east, and of course, with the in terms of the market share, the lower prices, the price cap actually allows Russia to undercut their other rivals, so allowing perhaps China and India to buy more, and then, or even Saudis buying some and then refining it and then to sending it back to Europe for higher prices. So it seems like if Iran come online, then they will still be competing with refined Russian barrels. So as in this, at least with the oil, because I'm not too sure about the Iran's oil products market, how much they've been exporting.
Well, they've got
there.
very naphtha yielding
Yes.
crude, so it's usually quite bearish naphtha when Iran comes back online, and naphtha's already having quite a bad year on a crack basis, refinery crack basis. So that would be under pressure, which would hurt the light sweet refinery margin levels, which would in turn be quite bearish the North Sea and refiner demand out of Europe. You see what I mean?
Yeah. So so Iran would be competing with not just the crude market in Europe, but also the oil products.
I see what you mean.
Oil products market, especially the stuff that Saudi, China, and India are sending towards Europe, which originally have some Russian molecules in it as well. So of course, like you said.
But I feel like the gig's up now. Like, you've maxed your cuts. Russia's getting back in via Europe, like you say. Like, it's the end of the day, we're not undersupplied. Otherwise, the physical differentials will be positive in the North Sea and kind of around that area. We've got like even Azeri light in the Mediterranean's weakening, like all the signals of that. There's overhang in West Africa. There's lots of exports coming from US. Like, there is not a production issue right now. So you're already propping up the market with your production cuts. You can only it's skewed to a production increase, if anything. And then you've got to fight with Russia and Iran for new market share if Iran come back online. You see what I mean? Yeah,
it's a difficult situation for sure.
Yeah, I mean, last time we were here was essentially the pricing war, but obviously a much more extreme scenario with COVID. But you can either cut, or you can cut or let the market do what it needs to do. And the extremes other side of the argument is to flood the market. I just don't know if that ever happens again. It's such an aggressive move. And now that we've reshaped the world's oil flows, I don't think it's going to hurt the shale oil community as much because they've got their rigid market share with Europe. So you flood the market and try and fight for market share. I don't know. I don't know if it works.
Well, what would work is that it would be very beneficial for the short investors, for the short sellers. They'd be very happy about it.
They'd be very happy.
Maybe not ouching, completely opposite of ouching, that's for sure.
Yeah, I mean, another quote out of this article. In OPEC, we don't target a certain price level. All our actions, all our decisions are made in order to have a good balance between global oil demand and global oil supply.
I mean, that's just OPEC rhetoric.
That's just what they say that, and then literally the article, is it the same day? No, or the day before. I'm going to make the market ouch. The short sellers ouch. If that's not about price, what? How can you say two things like this? People never challenge this. Like, those are two contradictory statements, right?
Yes. Yes. It's like, it's one thing. It's all rhetoric. Or OPEC are not going to say like, oh, they want to screw up the market, or oh, they want a particular price for that's up to like journalists, analysts, like interpretation. That depends on what we think. But of course, they're going to say like they're trying to foster a healthy, competitive.
Yeah, but they're not even saying that. Saudi ministers saying we're gonna make the short sellers lose money. So they're actually not even saying that. It's just like a.
So we'll see what happens on Sunday. That's definitely the one to watch.
No, I'm just talking about the journalists. Like, you know, try and put 2 and 2 together, surely. It's lazy. There we go. I keep advising them, referencing oil speculators, that they will be ouching. They did ouch in April. I don't have to show my cards. I am not a poker player. Didn't know this. But I would just tell them, watch out. How's that not poker?
Wow.
That sounds like that guy at the table on the poker table being like, I have a flush, mate. I have a flush. Swear on my life, I have a flush. Do you ever see Molly's Game?
No, I haven't.
Come on, man. Yeah, it's on Netflix at the moment. You should check it out. Basically, she used to run all these like celebrity poker games. Like I think they were kind of underground in Hollywood. There's like Tobey Maguire was one. There's a true story.
Oh, okay.
Yeah, and like one of the scenes, he's like basically bullying a guy to fold because he says he's got the best hand.
Wow.
And he's like, I swear on my mother's life, I swear. And then he folds. And then he shows his hands and goes, mate, I had nothing. Like, you idiot. Oh my God. Anyway, it's gonna be interesting. But I think if we're saying that the market's gonna suddenly change the way it, well, yeah, surely that has to happen next. So 2022, we had all these events. And then, like you said at the beginning, like people are talking more and more about financial flows and behaviors and positioning and these kind of things. So if that's an acknowledgement, you know, it's just playing out now. Like, surely the new game has got to be how to control the collective sentiment other than just production cuts. I don't know what the answer is. You got to be strategic. And sometimes you might even have to allow the market to wash out and get low, for example, to reconsolidate for the market to get long again. So for example, you tell an investor get long right now, there's all these different things. But if the market comes off a cliff down to, say, 45, 50, the reverse is going to happen. Like, there's going to be too many shorts in the market. There's going to be too much complacency. There's going to be a lot more end user demand. You know, inflation adjusted prices are incredibly low. And it's all good. And then you can start it up again and go, right, oil can go to 120 now. And it's at least a bit more believable. And you can get everyone back into the market on the long side. You see what I mean? There's a risky game. But that's the only thing I can think you would do if this is a game of poker.
You say, yeah, prices could go down to 45, but then we're closer to 120 now than, you know, if prices fall even further. So if anything, and also we mentioned that short positions are at 3-year highs as well. So of course, if the new flows come from the bullish hedge funds, bullish fast money, then the current shorts, they're at very high levels. So therefore they'll be really, really vulnerable to new bullish flows.
Sure.
So there's room for bullish headlines to come in and...
No, but that's my point. What I'm saying is just from a, like, if the price is lower, it encourages more bullish arguments and less justification to be short. That's all I'm saying.
Yeah, so more people saying, like, buy the dip, you know.
Yeah, but also the shorts take profit, get rid of that short, you know.
Yes. So more room, people eventually, for the average investor, they're thinking like, oh, okay, it's got to rebound sometime.
Yeah, and it's more like it's not necessarily bullish if the market goes from 40 to 50. It's just got a bit of momentum behind it. The market's constantly in a state of overbought, oversold by nature of positioning and flows. So it's just like not a huge amount of difference, 40 to 50. So that can happen, and then you can create momentum, and then you can get inevitably the press talking about 5 reasons why oils could surprise you this year. And, you know, retail brokerages coming out being like, have you considered investing in oil? There could be a 20% upside here, and that's the way it works, right? Yeah. Momentum works both ways, but I think trying to fight the momentum now is the dangerous thing, because if you keep propping, you're just like creating like a pressure valve, and then eventually just gives way.
Yeah. So you're just using it's a wrong time to use these bullets.
I think so. And now next time it makes it less convincing, doesn't it? Although next time there'll probably be hedge funds on their side being like, yeah, I want to be long as well. This price looks low. I can see the justification. I can see it in the macroeconomic indicators. In a year's time, or 6 months' time, the market might have turned around on a macroeconomic basis. You see, at the end of the day, it's risk reward. The risk reward being long now is not good, but $20 lower, it could be fantastic, and it could then go all the way back up and surpass the past levels. It's just,
I see what you mean.
You know?
There's more opportunities for this bullish momentum to actually be sustained.
Yeah. To the moon, as you always say.
To the moon.
Yeah. Okay, cool. I think we've talked that to death, but it's certainly a very interesting time after being pretty boring. So, looking forward to that. I guess we did talk a bit about the physical differentials being a bit lower. Data Brent market, those are the signs. It's kind of a similar story. There's a couple of big like bullish traders out there, but it looks like they're propping things up. We're grinding lower. So I guess we don't need to talk too much about that either. So unless you've got anything else to add.
No.
Or anything that surprised you in the last week or two?
If anything, it's just that the market tends to be quite surprising. If everyone thinks the market is going to go into contango goods, barrels are going to, there's not going to be much demand outlets or whatever. It's quite surprising. Either like certain players, certain trade houses, or whatever, they might have a bullish agenda or something, or that or whatever. But just from how I see the market over the past few months, every time there seems to be, when the market is on the cusp of a bearish regime, something happens which makes the physical differentials rally again, or just when people think it's going to be bullish at the time, market becomes bearish. So it's very fascinating, and it's very vulnerable to very abrupt changes. Just because it's leaning towards more bearish right now doesn't mean it's going to be bearish in the next week, perhaps, especially because of how the barrels, how Data Brent is priced. So yeah, it's very it's always ever very rapidly changing.
So you haven't been here that long, but you wouldn't think it, right? You picked it up really quickly. You're welcome.
Thank you. Well, a year's felt like I've been here for
years,
10
right?
years.
No, you picked up incredibly well. It's very impressive. But I think also, as I say, bringing this new spin to it. So the modern thinker, and not necessarily because you're young, but because of your interest in financial markets from the position of crypto markets, more digitization, financialization. These are all concepts to you that are not foreign, right? You understand them as your wider kind of environment is accustomed to these things like memes and things like that. So you managed to bring in that mindset. It was exactly what I hoped, to look at these markets that are very old school, opaque historically, and you're making them interesting with videos like Wu Fridays, and obviously your contribution to the research. But do you see it the same way? As in, like, you're looking at that lens, and it was almost like untapped in the oil market with the kind of legacy beliefs, or is it just coincidence?
I think initially it was a coincidence. Now it's more intentional. I see that, okay, it is definitely untapped. In a sense, before it just came, I think the evolution of these videos, it was just a natural thing. Of course, the producers gave me some hints, some nudges on, okay, you can be more expressive. You should be a bit more energetic, and I suppose I really had to embrace it. But
my worry with videos was always like, if someone does it who's only been here a short period of time, they're going to screw up the content basically. And like oil traders and the market who are going to watch these videos or watch content, whatever you produce, are going to be really like there to point out if you've done it wrong, right? And really ridicule you. So especially when you're building as a company, there's a reputational like threat there. But that's what I've never seen someone like so fluently understand something to the point where they can actually make it funny and tell stories. That's the essence of someone who really understands it. So I'm not sure if you're even aware of that, but that's the way it comes across to me. And that's what's been so fun to kind of produce things with you and watch the research team do it. And there's so much more ahead, right? I mean, this is just one aspect of what you and the research team do, but you must enjoy the freedom of that as well, right? You're learning you can be funny in this area, and you're trying different things, and obviously you also do a very serious job as well.
Yes, 100%. It's one of my favorite parts of the job, especially given that I get the creativity to and the freedom to write and produce, write the scripts and talk about the topics of my choice. And often it is a reaction to what's been happening in the markets over the past week. Sometimes I don't even know what topic I'm doing until the morning of the video. I just see what's interesting about it. And initially these, so initially the style we used to do was it's the same as like we're sitting on the table, laptop in front of us, we're just having some market commentary, but now it's turned into more of a TikTok style. So it's definitely different compared to, most of the time people think, they watch the market commentary on CNBC or Bloomberg. They think it's a very, very serious thing. But in a market as opaque as ours, it tends to be very bland. If you Google the stuff, not many people know what's going on. There isn't much explainers. So
the financial oil markets.
They're the financialized oil markets, the oil swaps markets.
But also just generally futures as well, right? There's limited out there.
There's limited information. So there was definitely a gap that was identified, and that's...
But one thing you also brought up was like you were enjoying it, but you were saying, but at the end of the day, this has got to help Onyx as well, right? This has got to help the research and bring the word out. And you tried to incorporate that as well. But did you see what Elon Musk said recently about... I mean, it's not like a new concept, but he was talking about...
He talks about a lot of stuff.
Sure, but about advertising, because the new thing is people are pushing him to advertise for Tesla. He's never done it before.
Oh, really? Has there not been advertisements for Tesla?
I mean, I don't want to be held... I don't want to die on that hill, but it was something to that effect. And he's saying, yeah, okay, I'll look at it then. But, he's saying that advertising should be more like content, right? And that's not a new thing. People have been saying that for a while now. It should be like some creativity to it, some artistry to it, as a way to promote your brands. There's more promotion versus advertising.
Yeah.
But I think that's what I think when people ask me, why do you do this stuff? I mean, you got to get your name out there. What company in the world who sells things does not advertise? And even if you don't sell something, you need people to work for you. You need to put your head above the parapet and say, this is what we stand for, and this is what we're about, and this is what we're trying to do. So I think that's what, even just by comedy or just by like the videos you do, for example, and obviously the work you do on research, that's what it's all about.
Yeah, I mean, it's an exercise in branding, but it's also providing a value to the wider market.
But is that how you think? I mean, we don't want to be like, it's not about being like political, right? Like genuinely, if it adds a value, you feel good about it and it comes across in the way you speak and people gain trust. I mean, do you honestly feel that way?
I feel that way, yes. It's very, very satisfying. And of course...
But why? Why does it add value then?
It adds value because our goal is to, or even how I see it is that the market is always very opaque. There's not much information out there. So by putting these, by creating these videos, by explaining these in an entertaining, informative way, it is giving.
But there's an education angle there. What you just said,
yes.
Making it digestible.
100%. Short and sharp. So of course we write it with that's the thing. So we write articles, we write research reports, but producing videos, writing the script for these, you write them in a completely different way. People don't realize like how different that is. Of course, if you're a YouTuber, if you produce these video content, if you're already used to writing scripts, you would know what I'm talking about. But it's writing the scripts, the style, the way you think, it's completely different to how you would write an article. You have to write it with the audience in mind, especially the types of words, the sentence structures you use. And it's writing a 2-minute video. It's easier said than done because there's a lot of cutting of sentences in the scripts. There's a lot of useless flaff that you have to actually cut out. You have to make sure everything makes sense.
To the point. Yeah.
It's to the point. So maybe that's why I haven't seen much criticism, because I try to keep the concept simple. So it's so it's not too complicated just yet.
Yeah, I agree with your value add. I mean, who else is doing that? Like a lot of people drone on. I mean, I guess we've drone on a little bit on this podcast, but that's the definition of a podcast in a way. But like, where do you go and find this stuff specifically on the financial oil markets? And there's this divide between, okay, we understand supply and demand, but something else is going on, but is anyone explaining it? And these kind of things are great. So you could be a newcomer, you could be an existing trader, whatever it is. I mean, I don't know why you wouldn't enjoy listening to things like that, but equally, it might be confusing for people who've never actually seen what we're talking about, right? Like Wu Fridays on Onyx Capital Group LinkedIn. Go check it out. It's hilarious. But also that's just one tiny bit of your job. There's a lot of things that, generally speaking, that's the mission that you're here to how do you word it? That's the mission.
To analyze the markets.
No, I'm saying I was trying to find the wording for. Yeah. Anyway.
Yeah, I mean, of course, I have the day-to-day job, but I think producing the videos, it's almost as a summary of what I've done over the week. So it's to solidify what I've learned, what I've been analyzing, what I've been writing, what I've been researching, and just putting it out there. It's just a snippet of, the 2-minute videos that people see. It's just a snippet of what I've been doing over the week, what I've seen. And perhaps I'm just trying to show the most interesting parts of what I learned and just showing that to the wider world. But
keep it up. Yeah. Because what will happen eventually, I think, is we're on this trajectory of financialization that just keeps going and going and going and going. And these 650 plus contracts that exist that aren't Brent and WTI that everyone knows about, that's going to become a lot more understood, I think. And, retail traders are going to get access to it. Institutions are going to get access to it, investors, and they're going to realize how important they are as just information. The prices of these contracts alone is great information. And it's just about access, democratization, everything we stand for. So yeah, you got to keep it up. And you said about you don't get criticism. Even if you do get criticism, it's irrelevant, right? You clear value add in mind. The moment you should be critical of yourself is when you're not adding value, right?
I think at the same time, as we're creating content, but just by virtue of putting ourselves out there, putting our video, putting our content out there, it's fair game. People can say whatever they want. When you have praise, of course, you can have criticism as well. So that's the, I guess that's just part of the game. You put yourself out there. You got to be open to all sorts of comments. You open yourself up to all of that. It's just part of the territory, I would say.
No, absolutely. Yeah. Thanks for your time, Vincent. I'm sure you're back on maybe either next week or sometime soon. That was really enjoyable. And I think we covered everything, right? In terms of what's going on recently. And
no, I think if we cover everything, it'll be a 3 or 4 hour podcast. But
of course, yeah.
Yeah.
Well, let's leave it there then. Yeah. No, thank you. All right. And for those listening out there, again, thank you very much for listening, and tune in next week. And that's all from us.